Real estate investment analysis involves a lot of attention to detail, since what might seem like really little things can have really big impacts on your cash flows and returns. And after underwriting thousands of acquisition opportunities throughout my own career, I noticed a few things that I definitely didn't pay enough attention to when I was just starting out, but are really important to consider and can materially impact a deal. So to make sure that you are accounting for these things, especially if you're just starting out in the industry, in this video we'll cover 3 things that need to be incorporated within any real estate investment analysis and the impacts that these things could have on your cash flows and returns. So the first thing here that's extremely important, regardless of the product type that you're analyzing, is to get clear on property taxes, specifically how and when the property is reassessed. Within the US, property tax reassessment practices can vary a lot from state to state, and the timing and the amount of a reassessment of property value can have a huge impact on your cash flows and returns. Some states, like California, will reassess property values immediately upon sale at 100% of the purchase price, which can make the property tax bill significantly different for the buyer than it was for the seller after a property trades hands. Other states, like Maryland, reassess property values on a predetermined schedule, for example, every 3 years or every 5 years, and this timing isn't going to be contingent on the timing of a sale. States can also have unique standards for how much assessed property values can increase year over year, with some states keeping assessed values flat for multiple years between reassessment periods, some providing a cap on the maximum annual percentage increase of assessed values, and some conducting assessments each and every year based on current market data and recent property sales. This is why if you own a commercial property in a state like Texas, for example, you might see huge annual property tax increases when market values increase, while if you own a commercial property in California, for example, you'll only see a maximum of a 2% annual increase regardless of how much higher market values have risen. Property taxes can also be one of the biggest, if not the biggest, operating expense line item for a commercial real estate investor, so it's really important to get this right, especially if you're underwriting a deal where your tenants won't be responsible for any sort of operating expense reimbursements that would include property taxes on a monthly or annual basis. And even if you are underwriting a deal with all leases, including something like a triple net reimbursement structure, meaning that the tenants will be responsible for reimbursing their pro rata share of operating expenses, including property taxes, assessed values are still really important to understand as an investor, since your tenants that are absorbing these increases are usually either going to be much less likely to renew their lease when that lease expires, or will immediately ask for a rent reduction to keep their occupancy costs at a more manageable level. Some tenants will also have specific protection clauses within their lease, which can cap their total property tax exposure, shifting the responsibility back to you as the landlord. And again, this makes it really important to know when a property will be reassessed and what that reassessed value is likely going to be. Now, in addition to property taxes, there's another tax-related consideration that investors need to make outside of just their personal income tax burden, and this is the transfer tax on a transaction and who is responsible for paying this amount. Transfer taxes are taxes that are imposed by state or local governments when properties are sold, and these are usually calculated based on a percentage of the sale price as a one-time tax that's paid out of escrow. And similar to property taxes, what these percentages are and market norms around whether the buyer or the seller is going to be responsible for paying these can vary a lot from state to state, county to county, and even city to city, and this can have a significant impact not only on the equity that needs to be raised up front when a property is initially acquired, but also at exit when you're ready to sell a deal. Earlier this year, the city of Los Angeles made huge news across the country when a new transfer tax went into effect on property sales greater than $5 million on top of the existing combined city and county tax of just 56 basis points, with an additional 4% tax on property value being applied to sales of over $5 million and an additional 5.5% tax being applied to sales over $10 million within the city of LA. And 5.5% on a $10 million sale can significantly alter returns, especially if this is something that you weren't initially expecting and didn't end up incorporating into your initial financial modeling. Some states, including Arizona, Montana, New Mexico, and Texas, don't have any transfer taxes at all, while others have transfer taxes that usually fall somewhere between about 10 basis points and 100 basis points of the sale price of the property, and many states and counties also leave it up to the buyer and the seller directly as far as who is going to be responsible for paying this tax. The point here is that while transfer taxes are sometimes an afterthought for newer analysts and investors, the impacts of these taxes can be material, and this is definitely something you need to get clarity on to make accurate projections when underwriting deals. Now finally, the last point I want to bring up in this video isn't related to taxes at all, but instead related to the rent a property is generating, and this is to get clear on any concessions being offered by a seller that might be impacting the rental rates on a deal. Oftentimes, when a property is being prepped for sale, the seller of the property will start offering rent concessions to tenants up front, usually in the form of free rent over a 1 to 6 month period, in exchange for tenants signing leases at much higher rental rates than they would have otherwise agreed to without these in place. This is especially relevant for multifamily properties made up of very short-term leases with just a 1 to 2 month free rent period, sometimes resulting in an entire rent roll of leases that might appear to be 5 to 10% higher than the actual rents in the market that the property could support. And to understand what true market rents are and what these rents might look like if concessions weren't offered at a property, investors will often calculate the net effective rents on a deal, which factor in both the amount of these concessions and the duration of the lease to calculate a true monthly rental rate over the entire lease term. For example, this might look like a 14-month lease on a multifamily deal signed at $2,000 per month, but the tenant actually received their first 2 months of rent for free, meaning that if we calculate the true average monthly rate over the entire 14-month period, this comes out to just $1,714 rather than the $2,000 a month that shows up on the rent roll. And without these concessions, you likely wouldn't be able to generate these kinds of rents after you acquire the property. So if you're not factoring these in within your investment analysis, you might be significantly overstating your cash flows and ultimately your valuations of commercial real estate deals. When you're underwriting real estate acquisitions, it's really easy to focus most on just the big ticket items or just assume that the seller's operations are going to continue exactly as they've been. But in my experience, this is very rarely the case. And these are 3 things that you need to be aware of that might appear small on the surface, but can have enormous impacts on the performance of a commercial real estate asset. And if you want to learn more about the real estate investment analysis process, or you want to build the skills you'll need to land an analyst or associate role at a top real estate investment or development firm, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the investment analysis process, make sure to hit the like button and let me know. And let me know in the comments if there are any other small details that you pay special attention to that other investors tend to miss. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.